Hi, good morning, everyone. Welcome to our weekly Monday webinar. Today we have quite a few stock updates. These are mainly from the US SSP presentation that we did last week. We also have several sector outlook like Singapore Banking Monthly, SG Weekly, as well as Technical Plus. So without further ado, let's just jump right into it. Just to flash the disclaimer for a little bit. Unfortunately, John today is unavailable to join us, so I'll be presenting on his behalf. Okay, we're going to start with the US Power 5. So basically, we're trying to do something that's like the absolute 10, but the US version. So we name it the Power 5. So basically, we're going to be picking 5 stocks in a bucket. So if we take a look at the S&P 500, we see like the sector that's doing extremely well is still technology, as well as consumer, but mainly it's coming from technology. So the 5 stock that we pick, 4 of them are tech stocks. One is the banking stock. So we cover semicon, cloud, advertisement, and then banking. So these are the 5 stocks that we pick. So all these 5 stocks, we either have a buy or accumulate rating for them. And we can see the year-to-date growth for the Power 5 is 47.5%, while the S&P 500 is 14.5%. So we think the growth is quite dominant here. So yeah, that's basically it. Okay, let's move on to the SSP US. So this is just a quick recap of what we shared last week. So we put a picture here. We picked the picture because we saw it's quite funny. It's NVIDIA as a giant holding up the entire market, which is the globe. So we think this is quite true if we're looking at the current state and kind of sets the tone for the US market. So for the investment scene, we have 3, all of them circling around AI. The first one we have is AI play. We expect semicon to really continue reaping the benefit from the initial ramp from AI demand. So a lot of the critical infrastructure is needed for AI. So what we potentially want to find out is how much a potential market is waiting for AI. We decided to use telecom investment as a proxy for what could be in the future state of AI infrastructure. The data is slightly incomplete, but it is quite clear that global telecom investment as a percentage of GDP is typically around a range of 0.4% to 0.8%. So if we were to take 0.6% as a rough median, this puts us at an estimate of $660 billion US market for AI infrastructure in 2024. And this could easily reach $1 trillion US by 2030. So our stock pick for the sector is still NVIDIA. NVIDIA growth is still robust. Their first quarter growth is 234% year on year. Their last 12 months is 200% year on year. The growth is still driven by data center GPU business. It's now seeing more demand outside hyperscalers like enterprises and Soviet nations. At the same time, we do see expansion in a gross margin. They have a gross margin of around 75% right now, which is even high for them because their historical average is around 60%. I mean, this just goes to being data center GPU really is a high demand product. NVIDIA is relatively well priced at 40 times forward PE. This is pretty much double the forward PE for S&P, which is around 20 times. This is relatively in line with your 10-year average. So the million-dollar question is, do we still think growth can be sustained? We think yes, because company is building a better ecosystem with more diverse range of products like foundry service, custom design chips, etc. They're trying to create an AI ecosystem similar as Apple Intelligence. So they're going to be able to continue to get the most out of this year. We also see a lot of long-term investment plans from hyperscalers. They're firming up and investing more monies. For example, recently, the Stargate project from Microsoft, they're just pumping a new $100 billion US. So it's very aggressive product rollout strategy. So we do think it's going to be able to keep ahead of its competition. So right now, we still maintain the buy rating with a target price of $140 US. Moving on to the second theme, which is digital advertising. We're still waiting on election. So digital advertising has been recovering well. The ad pricing bottomed out in the end of FY22, and it has been improving ever since. And we think the increased political campaign spending will definitely be a positive driver for the industry. Generative AI is also helping out a lot in terms of improving efficiency and driving the increase in cost per click. I mean, for the advertisement market, it's really just a demand and supply industry, so it's pretty transparent. Looking on to the next slide, we see election years, it tend to bond really well with the price performance. So we can see the graph here. So the orange block, the highlighted area, is election year. The two big player in the industry is, of course, Meta and Google. So we do see that these two companies, they do see a pretty good growth during the election years. We think especially so in the recent years because now social media has more and more importance in our life, and we do see that people start using social media more in terms of political campaigns in the recent years. So it would definitely be not wise to bet against these two companies during the election period. Our stock pick, I think for at least 2 years have always been Alphabet in terms of advertising. Alphabet revenue continues to climb steadily. Their growth accelerated over the last 4 quarters to about 15%. Ad revenue steadily improving as well due to their growth in the advertisement price. They're also trying to integrate AI to continue to drive better products. For example, they have better monetization due to products like YouTube Shorts. Another thing we was mentioning is big tech companies, especially digital ad companies in particular, they have been trying to cut down costs and still doing now. So Alphabet right now definitely has a leaner cost structure, which means better efficiency. Their operating margin is back to 32%, which is pretty much equal to their pandemic peak. Alphabet still stand to benefit heavily for election, like I mentioned before. Their valuation is around 22 times forward PE. This is in line with average, but we think there's still room to run given the investment in AI to support future growth. We expect earnings growth of around 25% CAGR over the next 2 years. Now I pass my time to Ambrish to share about our third theme, which is cloud computing.
Thank you, Helena, and good morning, everyone. So our next theme is that AI is fueling cloud computing demand. Next slide, please. Can you go to the next slide, please? Thank you. So cloud computing, it basically means that the companies or enterprises, they have to rely for their computing solutions like storage and enhanced security and performance capabilities on cloud service providers like the Microsoft Azure, Amazon's AWS, and Google Cloud. So as an instance, Netflix, it relies on Amazon's AWS to store all of its contents, and also it hosts its application on Amazon's server. And as a result, it does not upfront make any cost to build and maintain any IT infrastructure, but it still gets like a global reach as well as scalability, and also a better enhanced security solutions. So over the next 3 years, according to Statista, the cloud revenues are expected to grow by about 21% CAGR. And we believe that the two main growth drivers for this is the shift of workloads or information from on-premise to cloud-based solutions. And secondly, as more and more companies, they plan to integrate generative AI into their existing products. So they have to rely on powerful computers which can run AI models as well as analyze a vast amount of data. So we believe that AI, it should fuel the cloud computing demand going forward. Next slide, please. And in order to meet this rising demand, the big tech companies like Microsoft, Amazon, and Google, they have increased their capital expenditure spending over the last 3 quarters or so, as we can see in the orange line. So the capex for these companies, it had dropped significantly in 2022, mainly because the companies, they have reduced the IT spending mainly because of macro uncertainties. But now, as they are upgrading and building new data centers as well as procuring GPU chips. So basically that can run the AI or train the models. So they have increased their capex right now, and companies, they expect capex to remain at an elevated level over the next year or so. And we believe that this ramp up in capex, it should lead to higher revenues for cloud service companies like Microsoft, Amazon, and Google, mainly because the increased capex, it should lead to higher capacity, and as a result it could generate higher revenues. And also the upgrade in their performance capabilities, it could also lead to attracting new customers to their platforms. And as a result, we believe that it could lead to higher top line growth for the big tech companies. Next slide, please. So moving to the stock picks under our cloud computing theme, we have Microsoft and Amazon. So for Microsoft, we have the title like Azure is gaining market share. So if we look at the blue line, which is for intelligent cloud segment, it is the fastest growing segment, and it includes its Azure segment. So the Azure market share, it has doubled over the last 4 years or so, from like about 10 or 12% to right now at 25%, and it has been consistently increasing. So we believe that this is mainly because of strong demand, and also the Azure revenues, it's expected to grow by about 30+% in the June ended quarter. And we believe that the company should continue to gain market share, mainly because like a shift of workloads from the on-premise to cloud, as well as its integration capabilities with Office 365, and also witnessing strong demand for its AI tools. Like it basically helps companies to to integrate generative AI solutions in their platforms. Like for instance, if an e-commerce company plans to like install or integrate a chatbot into its website for maybe any customer inquiries, or any product related questions from customers. So basically Azure AI helps companies to build the chatbots on their platforms, and also other features like speech to text and text to speech, and also Azure AI search capabilities. Like it helps companies through a keyword search, wherein it could pull a data for customers. The Azure demand is expected to continue, whereas the green line is for productivity and business processes, and it mainly generates revenues through its Office 365 productivity software, and it's still growing at 15+% revenue growth rate. And we believe that this should continue, mainly because of strong demand for continued demand from product enhancements, and also continued demand from small and medium enterprises front-end workers, where it's required for to manage the daily workflows. Whereas the red line is for more personal computing segment, and it's witnessing a recovery, mainly because of the higher PC shipments, recovery in PC shipments as compared to the previous year. And also the gaming segment revenues, it jumped by over 50%, mainly after its acquisition, Blizzard Day acquisition, where the Call of Duty and popular games have been integrated on its Game Pass streaming service, and it has now resulted in higher player engagement. So overall for Microsoft, we have an accumulated recommendation and a target price of $465. So that's all for me. I would now like to pass it on to Helena for Amazon.
Hi, it's me again. Okay, so we actually have two stock pick for the cloud. So the other one is, of course, Amazon. So Amazon being the leader in the industry, it definitely benefits a lot from the driven AI demand. If we take a look at the AWS revenue growth, it has actually dipped in FY23. Its growth in FY22 has been really good, surpassing 20%, even 30% year on year. But starting from the first quarter in 2023, it starts to dip to 15%, then 12%. This is mainly due to consumers moderating their spending. I mean, during the hard period in COVID, where survival is the priority, the first thing people pull the plug on are innovative pioneer projects. So migrating workload from on-premise to cloud, that is something that they can wait for. It does not really directly impact their existing business, which is why AWS took a hit for the first few quarters. But then in the last quarter in FY23, we're starting to see the effects bottoming out. And in the recent quarter, which is the first quarter of FY24, we definitely see more signs of reaccelerating. Their revenue growth is reaccelerated back to 17.2%. We see a lot of consumers migrating workload from on-premise to cloud, either new consumers or the existing consumers who stopped previously due to cost cutting. So they're all slowly coming back. We think there is still significant growth headroom ahead because the theme of AI is going to be at least a 3 to 5 year theme. And if you take a look at the global IT spend right now, more than 85% right now still remains on-premise, not on cloud. So if cloud were to continue becoming the popularity, all these 85% eventually is going to become IT spend on cloud. If you take a look at the market share, Amber's just mentioned that Microsoft's market share has been doubling. But compared to their market share is around 25%. So if you compare to that, AWS still has a higher market share. They're still the number one in the industry at around 30%. The third competitor is Google. So Google's market share is around 11%. So this has definitely given AWS the edge, which allowed them to attract more new users, and at the same time make it harder for those who tried AWS in the beginning to switch to another cloud provider because it's quite troublesome and involves a lot of cost. I think if we take a look at AWS revenue, they right now only accounts for 17% of Amazon's overall revenue, and keep increasing sequentially. Right now, the growth rate already reaccelerated to 17.2%. So we're confident for it to reach above 20% really soon. So this would be a much faster growth rate compared to Amazon's retail sector, which means that it is going to take up a bigger portion of the pie. So this would definitely help with Amazon's margin significantly because AWS is an extremely high margin business. Its operating margin is as high as 38% compared to their retail margin, which is only single digit. So the real kicker will come from margin expansion as AWS start taking up a bigger portion of the pie. Amazon is already seeing a significant increase in the margin expansion from only 2% in the end of 2022 to now 8%. Of course, partially this is also thanks to their effort of regionalization and cost cutting in their e-commerce sector. But AWS expansion is definitely playing a big role in there, and we expect to see a bigger role in the future. On the other hand, management has disclosed that there will be a significant increase in capex in 2024 in order to boost their AWS growth to keep up with the existing demand. So such increase we already see on the way. In May this year itself, the projects they have announced in order to boost their cloud infrastructure around the world add up together is around $40 billion US. If you want to compare, their capex for the entire year last year is only $48.4 billion US. So for a single month, it's pretty much almost the same amount. So there's definitely a huge increase. So we forecast around a 12% revenue growth for Amazon. We maintain our rating of a buy rating with a target price of $220 US. So that would be all for the US SSP sharing. Now I pass my time to my colleague Glenn to share about banking.
Hey, thanks, Elena. Yep, so we have the Singapore Banking Monthly. We're moving on to the interest rates. So the interest rates were rather flat, at least the Singapore ones. This is a sort of mirroring what has happened with the Fed fund rates. So the interest rates were actually down 1 basis point to 3.67% in June, and this was slightly reversing the small increases it had for the past 2 months. But nonetheless, if you look at it year on year, it did rise 2 basis points, and it's also 1 basis points higher than the second quarter average. We have been noting that the 3-month SORA has been hovering around this 3.6-ish range since the start of the year, since January of 2024. And we also expect it to be maintaining at these levels following what the Fed fund rates has been doing, also rather flat. But if it does have a dip, that will most likely be in the second part of the later part of the year if there is any cuts to the Fed rates. As for the HIBOR, it actually recovered in June, and it was up 8 basis points to 4.74%. And this is a continuation from the increase of 13 basis points in May. Now, moving on to the next slide, we'll be looking at the loans growth. For the overall loans to Singapore, it dipped by 0.3% year on year. And this dip was actually slightly reversed the growth from the previous 2 months. However, we still do continue to expect low single-digit growth for 2024, as loans growth is expected to turn positive going into the second half of the year, as consumers start to feel more comfortable with the high interest rate environment, and also with some expectations of rates to decline in the second half of the year. For the business loans, it fell by about 1% in May, and this is mainly due to the continued decline in the loans to the manufacturing segment, while the building and construction segment loans was flat for the month. For the consumer loans, it also continued to grow strongly. It grew by 1.1%, and this was the 5th consecutive year-on-year increase recorded since December. So what propped up the consumer loans was actually the housing loans, which grew by 1.2%. For the total deposits and balances, it grew by 4% in May, and the CASA, or the current account and savings accounts proportion, dipped slightly to 18.1% from 18.3% in the previous month. For the Hong Kong loans, it has continued to decline. So it declined by 5.5% year-on-year and by 0.4% month-on-month in May. So now moving on to the next slide, we'll be talking about the SGX statistics. So the SDAV, or Securities Daily Average Volume, fell by 6% year-on-year in June, while the DDAV, or Derivatives Daily Average Volume, grew by 13% year-on-year and 2% month-on-month in June. While the VIX, which is a market index that measures the implied volatility of the S&P 500, averaged 12.7 in June, and this was down from 13.1 in the previous month. So it's slightly less volatility, sorry. For the top 4 equity index futures turnover, sorry, this is the right chart here. I think there's something wrong with the words. The top 4 equity index futures turnover, it fell by 10% year-on-year in June to 10.4 million contracts, mainly due to the lower trading volumes of the Nikkei 225 as well as the FTSE China A50 index. So we have compiled some data for the first half. I think there was also a question in the chat asking why the sudden share price increase in SGX, and what's the outlook. So this is a good indicator for the SDAV and the DDAV. Is a good indicator to show how SGX will do, at least in their equities cash as well as equities derivatives revenue. So for looking at the first half figures, first half 24, so it's from January to June, and that is the second half FY24 for SGX. So SDAV was up 5% year-on-year as the market sentiment improved, and there was a broad-based recovery in the ETFs, fixed income ETFs, as well as their REITs. And notably, Singapore was also the second most actively traded market in Southeast Asia in the second quarter of 2024. And in addition, the second half DDAV, the Derivatives Daily Average Volume, was also up 16% year-on-year, mainly due to a rise in the risk management activities, which drove derivatives volume growth in FX and commodities, as volume was lifted from market participants hedging amid shifting expectations for interest rate cuts. So what does this mean for SGX? We do expect a recovery in their equities cash as well as equities derivatives revenue for the second half of their financial year, as trading volume has improved for the period. And this is also potentially resulting in their equities revenue increasing by around 8% year-on-year, or in other words, adding around 28 million to their revenue from the previous year's half. So for SGX, they will announce their second half FY24 and full year FY24 results after the market closes on 7th August 2024. So in a few weeks' time. Now moving on to the next slide, we'll be looking at the Singapore's banks' performance. The 3 banks' share price performance was rather mixed in June, with UOB performing the best, the only local bank showing an increase of 2% for the month, while both DBS and OCBC dipped similarly by 0.6%. But if you look at it as a year-to-date basis, DBS still performed the best with the largest increase of 18%. So you look at this, the third last column here, so 17.8, 18%, as compared to OCBC and UOB with increases of 11 to 10% respectively. We feel that DBS has continued to perform well, likely due to their dividend guidance being the highest amongst the 3 local banks, as well as providing very clear guidance for their dividend growth in the coming years. And look at OCBC and UOB, they are maintaining their guidance of a dividend payout ratio of 50%. They also not have given much clarity on how their excess capital will be returned to their shareholders. Hence, so we still do expect that DBS will continue to be the best performer amongst the three local banks. Now, moving on to the next slide, we touch upon slightly, this is a topical topic. So, sorry, next slide, please. Yep. About the three local banks' Greater China exposure. Looking at their FY23 figures, the three local banks combined have reported that 15% of their profit before tax has come from Greater China. Greater China meaning mainland China and Hong Kong, with 18% of their total loan book from Greater China. So which bank has the largest exposure? That would be OCBC. They have 21% of their profit before tax, as well as 24% of total loans from Greater China, while UOB had the lowest, with profit before tax and total loans at 6% and 15% respectively. So for the funding and deposits, it was relatively similar, with an average exposure of around 9%, and DBS and OCBC at 11% each, while UOB again the lowest at around 6% of total deposits. So that's it for the China exposure. Now moving on to conclude, the next slide, please. Yeah, we do maintain overweight and we remain positive on the banks. The net interest margins for banks will likely remain flat in FY24, despite the higher for longer interest rate environment. But we see that loans growth and fee income recovery will uplift the bank's profits. The bank's dividend yields are also remaining to be attractive, with upside surprises due to excess capital ratios, as well as the push towards higher ROEs. So that's all I have for the banking sector. I'll now hand it over to Darren for the REITs. Thank you.
Yeah, thanks, Glenn. So for the US office REITs, this is just a quick update, but the update is mainly because Prime US REIT, they have their loan that's expiring in a few days' time. So I'll just have some updates on general US office REITs for the first quarter as well. So first of all, we take a look at this chart on the left. So this shows the portfolio occupancy of Core, Capital Pacific US REIT, Prime US REIT, and Manulife US REIT over the past 5 years, and in first quarter 2024 as well. So as you can see, the most stable one, the one that managed to maintain their occupancy at around 90% is Core, followed by Prime. Prime, the occupancy declined from 95% all the way to about 80% in the first quarter 2024, and Manulife from 95%, they declined to about 78-ish% in first quarter 2024. So the leasing momentum and basically the US office is still quite weak, but we expect it to possibly recover and towards the end of this year or next year as interest rates come down. So that will likely help with the transaction market, which I'll show in the next slide. But before that, I will the chart on the right, it just shows some of the stats of the Core, Prime, and Manulife. So right now, aggregate leverage for Prime is at 48.1%, but after they divested One Town Centre, the aggregate leverage has fallen to about 45% because they used the proceeds to pay off some of the debt. And Manulife still remains in a breach, or not say breach situation, but their aggregate leverage is still above the MES leverage limit of 50%. So Core, they took a more proactive stance. They kind of wanted to keep the leverage within the 45% without breaching it. So Core and Manulife, they have halted their dividend payments. Prime, they paid off 10% of their distributable income in the second half. So that's just a quick rather reminder of what happened in the most recent quarter. So going forward this year, unlikely Core and Mas will pay any dividends. Prime, maybe they'll take a more dynamic stance for that. So yeah, I'll move on to the next slide. Yeah, so for Manulife US REIT, this is the things that they need to hit, or rather the picture on the bottom left. So by December 2024, they need to dispose 230 million of assets. If not, you have to incur a small fee. So this is part of the recapitalization plan. So this small fee is 2.8 million. That's the maximum amount, but it's likely will be smaller than that if they manage to divest some assets by then. And by June 2025, they have to dispose 330 million by then. And overall, the whole recapitalization plan will end in December 2025. So right now, they're still trying to divest of the assets, but we note that the transactions market is still weak. It's slowly improving. Hopefully, it will improve as interest rates come down later this year. And for Prime US REIT, basically, like I mentioned at the start of my presentation, is that they have a 600 million credit facility that's due on 18 July. So that's basically 3 days' time. So they issued an update a few days ago saying that right now they are in the final legal documentation to refinance this whole loan. The delay is because one of the lenders, they need a little bit more time to finalize their internal documentation. The other three are already ready to close. So basically, this refinancing we can say that is done, and the maturity has been amended or extended to 1 month to 19 August. Yeah, so that is basically it for Prime US REIT. We expect them to be able to refinance, and yep, we hope for some good news probably by their first half 2024 results. Yeah, next slide, please. Yeah, so now I will just run through First REIT's initiation that was done at the start of this month at the reports. So just some quick updates on that. So first of all, First REIT is a healthcare REIT that's focused on investing in real estate or income producing real estate in the healthcare sector. So right now the portfolio is 82% of their full year 2023 results. It came from Indonesia and 14% came from Japan. But AUM wise, 75% of their AUM is in Indonesia. So for them, the sponsors are OUE Healthcare and OUE Limited. And they have right of first refusal from some of these from their sponsors as well as from Lippo Karawaci as well. So for them, Siloam and Lippo Karawaci are major tenants, which is basically the hotels in Indonesia. Yeah, next slide, please. Yeah, so for the investment merits, basically right now, they restructured their master lease agreements in 2021, which was effective January 2021. And the restructured master lease agreements, it's for Indonesia, is basically the higher of the base rent of 4.5% or the performance-based rent that is based on the preceding year's gross operating revenue for the individual hospital. So that's 8% of the gross operating revenue for the preceding year's hospital revenue. Yeah, and for Japan is basically the rental is flat, but every 2 to 3 years or every 5 years they can renegotiate based on CPI and interest rates. And for Singapore, there's a fixed increment of 2%. So as most of the income is from Indonesia, so the important part is the higher of the base rent, 4.5%, or the performance-based rent that we need to keep a lookout for. So they also have a long WALE of 11.3 years. So it's 11.3 years. Most of it is due to the fact that the Indonesian hospitals, their leases expire in 2035. So basically, their escalation for 4.5% is for another 10 years or so, or 11 years. So basically, that is the base case, but we expect the performance-based rent to kick in as the Indonesian hospitals perform better. Yep. And then another factor is that the exposure to Lippo Karawaci will decrease from 88% before the restructuring, which was before 2021, to less than 20% after 2026, assuming all the rentals are based on performance-based rent. So this arrangement was done after Siloam was added as a party into the master lease agreements. And the thing about that is much better now because Siloam is a cash cow. Their revenue has been improving, their operating performance has been improving due to the increase in the basically all the customers, more people going, more patients rather, that's the word, yeah, more patients. And Lippo Karawaci is a property developer. They're experiencing some tight cash flow since FY19, and yeah, basically that the cash flow is tight. So that's why as we decrease exposure to Lippo Karawaci and increase exposure to Siloam, that's better for the credit for First REIT as well. And the next investment merit is that they are basically recycling capital to fund their expansion plans. So they are targeting to divest some of the non-core assets, and some of the assets include the Hotel Country Club, which is on a 1-year lease renewal. So we are likely to see them be able to divest that soon. And they are also looking to divest some of the older nursing homes as well as some of the Indonesian hospitals that have reached a mature state. And it's also likely that Siloam will want to buy back some of these hospitals because they are doing so well. They want to avoid paying rents. So yeah, if conditions are right, First REIT might just sell it back to Siloam. And next, as part of their First REIT 2.0 strategy, they have an expansion plan into developed markets. So they are targeting to have about more than 50% of their assets under management in developed markets. Right now, it's about 25%. And this will help to benefit them because right now they are very, very heavily exposed to the Indonesian rupiah, as the rental that they collect from Indonesia is all in Indonesian rupiah. So that will reduce the exposure to Indonesia as well as the depreciating IDR. But the thing about First REIT is that right now they are trying to hedge some of the foreign source income. So they're targeting to hedge about 50% of their foreign source income. Right now, it's about one third of it is hedged. Yeah, next slide, please. Yeah, so the next slide is just the left side, the debt maturity profile. They do not have any loans that are expiring until 2026. And the 4 pillars to their First REIT 2.0 growth strategy is basically, like I mentioned earlier, is one of it. The important ones are the diversification into developed markets and the reshaping of the portfolio for capital efficient growth, which means divesting some of the non-core assets. Yeah, next slide, please. Yeah, and for the risk for First REIT, the most important risk for them is the FX risk, as any depreciation in the rupiah will affect them quite significantly, as well as the yen. But because over 80% of the income comes from rupiah, so they are heavily affected by that. And also, any depreciation of the currency could also affect their gearing, as the value of investment properties when it translate back will be affected, and then that will affect the gearing. And for valuation, the risk for Indonesia hospitals, we think the valuations will improve over time because of the 4.5% base escalation. So the valuations is relatively will improve over time in our view. And for Singapore assets, because of the lease decay, the land lease decay, it will slightly keep decreasing. And for Japan, because the demand is there, investor demand and cap rates remain relatively stable, maybe compress a bit, the valuations are relatively stable as well. And interest rate risk, of course, and right now they have some income that's owed by MPU, so the manager is actively engaging MPU and trying to settle and come up with a repayment plan for them. So they owe about 5.2 million in rents. Yeah, and on the right side is basically just the DPU, our forecast. Due to the very weak Indonesia rupiah this year, as we saw year to date, it's already down over 4%. And yeah, so basically because of the weak DPU, because of the weak rupiah, we expect DPU to fall to 2.36, but we expect it to pick up next year as the interest, all the base escalation comes in, the 4.5% comes in. So yes, and interest rate, the risk, basically interest rates likely to come down as well. So that will benefit them, as some of their hedges expires at the end of this year, their interest rate hedges. Even though their loans, we saw they don't have any refinancing due, but some of their interest rate hedges expire, about 1/3 of them expire 2024. Yeah, next slide, please. Yeah, so with that, we initiate coverage on First REIT. First REIT is now traded at 0.8 times price to NAV, and it's still below the S-REIT average of 0.87. And right now, the cost of equity, we use the dividend discount model. We use 10.5% and a 2.2% terminal growth rate. So First REIT at this 2.36 dividend DP distribution per unit is paying about 9.6% forward dividend yield. And the chart at the bottom is basically how First REIT compares statistics-wise or valuation-wise to Parkway Life REIT. So we think First REIT is more attractive based on price to NAV, 0.8 times versus Parkway Life REIT 1.5 times, and as well as the trailing yield. Parkway Life REIT is only paying about 4.2% trailing yield. First REIT is paying about 10%. Yep, so that's all for the initial of First REIT. I'll hand over the time to Zain now. Thanks.
Thanks, Darren. Good morning, everyone. I'll move on to the technicals. Next slide, please. Yep. So first up, looking at S&P 500. Last week it tested the uptrend channel resistance, which is in blue. So for this week, I think we're likely to see some form of sideways consolidation going ahead, with immediate resistance at 5,630 to about 5,660 area, while support could lie at 5,540 to 5,585 area. Next slide, please. Yeah, so for individual counters, first one, we have a technical buy stop for GE Aerospace at $165.99. Take profit level at $183. stop loss at $160.65. Last close price was $159.01 on Friday. So looking at the chart for GE Aerospace, it's been consolidating in a wedge formation in blue since April this year. And then with a recent bullish crossover on MACD where it actually went above the zero line as well, could see that it's possible that the price will actually break out this consolidation soon. Projected target level will be about at $183 when we take the height of the wedge and project onto the breakout level. Next slide. Yeah, so next one is on Uber Technologies. We have a technical buy stop at $73.65. Take profit levels at $81.80 and $84.30 respectively, with a stop loss at $69.50. The stop loss goes at $72.43 on Friday. So looking at Uber's chart, it's actually looking better than some of its peers such as Grab as well as Ride. Currently it's forming an inverse head and shoulders formation, which is in blue in the chart. Neckline resistance is at $73.60. So with a bullish crossover recently on the MACD, there's potential for the chart to actually break out this consolidation if it breaks over the resistance to head towards $81.80 first, which was the previous horizontal resistance level in March this year, then followed by $84.30, which is the projected target level when we take the height of the head and shoulders and project onto the breakout point. Yeah. Next slide, please. Yeah. So this is a summary of the two trades initiated. Currently, GE Aerospace haven't triggered yet because the price haven't crossed above the buy stop level. As for Uber Technologies, it's currently in progress. It's down about 1.6%. Yeah, so that's all from me now. I'll hand over time to Paul to talk about Singapore Weekly. Thanks.
Yeah, thanks, Zane. We'll just run through next slide. Just run through some of the key macro highlights for last week. So for Singapore, the key one was the visitor arrivals or tourist arrivals into Singapore. It's slowing down, but it's still about around 11%. It slowed down from the May's 15%. What could happen is that it could trend back to pre-pandemic. So the pre-pandemic 5-year average, that means 2015 to 2019, the growth rate was around 5%. So it might trend back to those levels. Right now, it's still double that level. So which visitors are the ones that are not coming? Or Indonesians were down. China continues to be the backbone of the recovery. Is up or is doubled. 90%. And even Europe is also still growing about 15%. We also sometimes monitor the export sector, especially through Korea and Taiwan. So in a nutshell, first half for both Korea and Taiwan, we do see exports recovering 9 and 10%. But they are recovering from a really weak first half of last year. So last year declined 12 and then 18. So this time now we're just bouncing back to the similar levels of last year. Sorry, of the year before, the 2022 levels. So there is a recovery, but I wouldn't say like it's a very robust recovery bounce in the export sector. We got some key numbers from the US, which is the CPI inflation. Oh, so sorry, I think that there are some errors there. Please ignore that line here. I think it wasn't really updated. Apologies. The other one is the bank loans. We'll talk about the CPI, later. But the CPI was actually up 3.3%. That's a tad below the forecast of 3.4, which is the core inflation. So for bank loans, is also returning into the US. So loans growth is returning the highest in 14 months. Yeah. Sorry for that slip up. Yeah. Next slide. We'll move on to our tactical views. So because of the better than expected in inflation, the core CPI was a tad above expectations, I think like 10 basis points. I think the market is now pricing in almost a done deal that there will be a September cut. So there's a 93% probability that the first rate cut will happen in September. In total, the market is still pricing in 2 rate cuts, one in September and then one in December. When we look at the CPI, we have a chart later, but we look at line by line all the inflation segments. We think what is positive is shelter inflation, and we'll discuss later because that is like on the structural downturn. Can you go back? I haven't finished. go back. One more slide. Okay, so the other positive comment was also coming from Powell, that 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 for them to cut rates, for them to get confidence whether to cut rates, they just need interest rate, the path to be. Can you go back to the slide? Okay, okay, I'm not sure why the slides about what's wrong with the slides. Okay, but anyway, the slides keep moving. Who's controlling the slides? Okay, but anyway, our view is that inflation is going to come down, and then the two REITs in our model portfolio, which is not on this slide anyway, but the two REITs in our model portfolio is Comwell and also OUE REIT. If you the other thing to highlight also is that there was several ASEAN equity strategy pieces, which of course we can't see from here. But anyway, so yeah, anyway, the ASEAN team, I give up. The ASEAN team here is the listening to the various equity strategy. The team for Malaysia is actually, there's a capex cycle underway. What is happening is that there's a capex being spent on infrastructure, which is highways and trains. Another area of capex is also oil and gas, and then the next is data center. So ultimately the main theme in Malaysia that's going on here is that there's a big spending underway. So Petronas is also raising their budgets. For Thailand, their main theme, having listened to 3 hours of all these countries, the main theme is that the weaker currency in Thailand, the weaker Thai baht, is going to drive food exports, healthcare, tourism, and also in general, the tourism in general. For Indonesia, the problem for Indonesia was that they are having a twin deficit issue, so which is a fiscal and current account deficit. So that's why there's continuous pressure on the currency. But in second half is also going to be weak. So Indonesia is going to be reliant on commodities export and also government spending. There are going to be lots of events happening this week. The key ones are in green. So there's going to be the China third plenum, which happens, I think, every 5 years. And then there'll be some of the results coming out. Some that we cover are like Netflix. This is all just for your reference. Then on the 17th, our corporate insights webinar, we will have one Nasdaq listed Chinese company, if there's still any interest, but they are e-commerce company, but they are listed in Nasdaq. So if you want to learn more, feel free to dial in. It's open to everyone. Then the following days, we have lots of REIT doing presentations with us. Next slide. Okay, but so this is the inflation data that we try to decipher. So the underlying inflation is in the red line, but the one that's encouraging is the black line, which is shelter. So we do see that shelter is coming down. So this is a very long cycle type of inflation, because it doesn't really it trends very long. So this is the one that is still high. It's about 6%. What's helping inflation come down is actually goods inflation, the green line, which is turning negative. I guess probably China providing the disinflation. Next slide. This slide is important for the REIT sector. So this is where the Fed funds expectations are. So the blue line was where at December 23, this is where investors expected inflation to be. You can ignore 2025, and that is where those are more the Federal Reserve's forecast. But if we look up to December, interest rates were supposed to drop from 5.25 to the 3.8. But instead it spiked up to 4.9 in June, and then that of course what hurt all the REIT stocks. But now it's starting to come down again. So the market is now, again, like I mentioned earlier, pricing in the September and December rate cut. So that's why this is the latest number, which is about 4.7 or 2 rate cuts for this year. You can see the in beige here, the 25 basis in third quarter and 35 in the fourth quarter. Next slide. I just have two last slide. Then I don't have to go keep on flicking the slides. So one is Fortress Mineral. So Fortress Mineral did a first quarter analyst briefing. So they are essentially iron ore producer. They are one of two iron ore producers. Their mines, they have two mines in Malaysia. I mean, just in case anyone doesn't know where Terengganu is, but one is in Terengganu and the other one is in Pahang. They have also two exploratory sites in Sabah. So the numbers were down, the profit was down because there was a big decline in the revenue, but that was more of a timing issue because they sold 104,000, which was flat, but they had 40,000, which was down. They had 40,000 of metric tons of iron ore that was delayed because there was a shipment delay. So that should see very strong numbers coming up in the second quarter because that was going to push back, roll over to the second quarter. So their key producing mine is Bukit Bersih. So that the expanded capacity and they're guiding that they can grow by 20%. So in 2025, so 2025 should be a good year for them, assuming the iron ore price kind of stays these levels. The one big mine that they're working on, Mengapo and Pahang, that will take 2 to 3 years. The capex is almost 40-50 million. So this one will take them to the next level because this is not just an iron ore, but they're going to enter into copper. But you still have to fund this capex because bank funding is literally not available. So this will take time. They still got a draw plan. I guess look for funding, and then take 2-3 years to complete it. But this will make them from an iron ore to iron ore and copper producer. They also have they're exploring 2 areas in Sabah. This like 400 square kilometer or more. It's like half of Singapore. But these are exploratory and they're doing drilling rigs, and then they'll take 2 years. They're probably going to, if everything works out, they're probably going to develop nickel and copper. So in a very near term, FY25, they should have a strong results because production is going to jump 20%. The chart on the left here is just to give you a flavor of iron ore price, which is in red. So our iron ore price has basically moved sideways. Even though you can see that the Chinese continue to import, continue to achieve record imports of iron ore, but the narrative or the concern the investors have is that the iron ore imports is just to complete some of these residential projects in China. And once that is done, there could be a collapse in demand. So that's the worry. And that's why even though demand is strong, the iron ore prices don't really climb up. No, it's not like copper because copper is more linked to renewables, where I think the market is more positive on it. They are the so-called clean industrial or green industrial commodity. I'm not sure what that actually means, but anyway, that's how they tag it. Next slide. Oh, okay, this is my last one for me. So we had Pacific Radiance. They did a Copper Insights webinar for us. So Pacific Radiance is almost like a Marco Polo turnaround story, but probably delayed 2 years. So they market cap 45. So they have 3 business now. They have a shipyard in Singapore that does mainly repair work, and then they have a vessel management. So vessel management is like you're a fund manager of assets because they don't have the balance sheet, so they're actually managing like 30 vessels. Then because they did a rights issue, so now they have vessels to operate, which I'll elaborate later. So just to dial back, they had a major restructuring in 2022. They sold 33 vessels to a private equity fund, Riverstone, not the glove maker, to clear almost 500 million of debt, and of course some of it is debt forgiveness. So in the shipyard, one business they have shipyard is repair, but I mean we asked, can they do shipbuilding? That part they need some capex to do it, especially like lifting capacity and so forth. The one that gives them recurrent revenue or at least pay the bills right now is the vessel management. So they probably charge a fixed fund, maybe I don't know, 15,000-20,000 a month for each vessel that they manage. Because a lot of these vessels these days are owned by financial investors that don't have experience to run all these vessels. So they have it, and these vessels are actually used to be owned by them anyway. So the big growth driver for them would be the OSV operator as a OSV. So they have reactivated 3 vessels. They are here the AHTS you see here, and then the multi-purpose vessel and the accommodation barge. The utility vessel I think was all along in the balance sheet. So this will be the three vessels that will generate earnings for them, most likely next year. The other thing that they have is they have this 30% listed associate that they totally write off. There's no value in the books right now. But in this associate, they actually have 41 vessels in Indonesia. There's a restructuring going on, so they will look to try and sell some of these assets and redeploy them in more lucrative international waters. Just two last points for me is that they just mentioned that the industry is doing well. That continue to see AHTS rates. I guess we heard this like the usual 2014 story. All the AHTS rates are climbing. Used to now like more than $1 per horsepower and so forth. And just to give you a sign of the limited supply, only 2% of new orders are OSVs are being ordered. So let's say out of 100 ships, vessels in the sea right now, only 2% is being ordered. And not like container, like 40, 50%. So and even if you order now, it takes 3 years. So it's a very tight supply condition. So in terms of the outlook, I mean, this is our own view. I think they just completed the rights issue, so now they're debt free, and there should be some stronger earnings because they have these 3 big vessels plus some CTVs that they are going into. Okay, I think we can move on to the Q&A. Thanks, everyone. Can some take some questions first?
Yeah, let me take I'll try answering this Taylor Swift My Celebrity Event has this cost tourist counters to move up. Yeah, so it will benefit the like Escort or Genting Sing. I'll leave Genting to Paul, but companies like Escort, they will benefit from higher RevPAR. So yeah, it will flow through to the financials. But the impact might not be so immediate. Like just because Taylor Swift coming doesn't mean that the share price will run. Yeah. Um. Looks like the outlook for both Manulife Prime REITs are unlikely to have any meaningful turnaround in the near term. Yeah. I think any meaningful recovery will likely come from any interest rate cuts, where as the cuts come, then likely the when interest rate cuts come, then likely transactions volume will likely pick up, as well as it's cheaper to borrow money. And yeah, hopefully Manulife, they were able to hit the restructuring 330 million by next year, July, or was it June? Yeah, so to complete the restructuring plan and do not default on the loans. Because right now their loans have been extended by 1 year. Yeah, so mid to near term, maybe the recovery not so, but yeah, by 2025, we are expecting a recovery by then. We expect Prime REIT to move up when the loans are finalized. That's the gearing ratio. Yeah, so the gearing ratio, once they finalize the loans, will likely be about 45%, which is the current levels. And yeah, so what happens when the USD declines? So for Prime US REIT, since their financials are in USD and they collect everything in USD, so you won't really be in fact impacted, because any distributions or their reporting is all in USD also. So there's no like translation losses or whatever we call that. Yeah. Yeah, and when Prime refinances the loan, we do expect we actually tag our target price 0.2 times when Prime doesn't refinance, and 0.3 times if they refinance. So if they refinance, we do expect the price to move up to 18 cents. Yeah. But yeah, correct. That's our are there any loans to be refinanced for Fraser's Lock and Fraser's Centrepoint Trust. Yeah, so for Fraser's, for FCT, they do not have any loans that are due for refinancing this year. And for Fraser's Lot, they have about 22% of their loans expiring. So yeah, let me pull out the stats. Yeah, so for gearing wise, FCT is about 38% and FLCT is about 33%. And cost of borrowings, FLCT 2.6 and FCT is about 4.2%. Yeah, so that answers the questions. FCT, we have an accumulate call with a target price of 2.38. FLCT we do not cover, so maybe Zane can do TA if there's time. If you have choice to buy one healthcare REIT, which one to buy, First REIT or Parkway Life REIT in terms of balancing? Yeah, we prefer First REIT. I'm not sure whether you saw my chart at the start. Basically, because of the fact that they are trading at cheaper 0.8 times price to NAV, as well as their yield also, their dividend yield is higher. The dividend yield in fact is double or even more than Parkway Life REIT's dividend yield. So of course you have to stomach some of the Indonesia rupiah risk, the depreciation of the rupiah, but regardless, you're still getting more than double the dividend yield. So we prefer First REIT. Does First REIT sponsor own assets in these markets? Yeah, not many. They do have some assets in Japan, but it's not significant. So basically, the diversification into developed markets, I would say, is more from third parties. Yeah, I think I'll hand over to my colleagues. Thanks.
Yeah, maybe I'll take some of the questions. Let me just any hints on the Q2 earnings for Singapore banks? Yeah, Singapore banks, I think it will be relatively similar to the first quarter's results. So what we're expecting is that their net interest margins will remain, net interest margins and net interest income will remain largely flat-ish, right? If hopefully it will remain flat, right? It doesn't go down. If it does go down, it should be within our expectation, few basis points dip and a few low single-digit percentage decline in the net interest income, and that is to be expected because of the higher interest rate environment. Their cost of fundings have actually crept up, right? I've mentioned this several times. So the cost of fundings have crept up, but their asset yields are rather flat. So hopefully they'll be able to put back some of these assets, excess assets, and funds that they have into higher yielding interest products, if they're able to do that. And what will be growing, so what will not be growing would be the NIMs and net interest income. Another thing will also be their loans growth. Although we have seen several positive signs, right, looking at the MAS statistics and data, that the loans growth has recovered. So not in May, but you look in March and April, right, we have seen it finally reach that positive side. So we have seen low single-digit growth. So we might see some improvement in their loans growth, at least for the second quarter, and that could be very beneficial for the banks. So what we'll see that is growing and that is benefiting the banks, who will provide growth for their earnings, would be their fee income. So fee income has been in a double-digit growth, and we also expect it to continue as the investor sentiment has shifted. Their AUM or assets under management has also been growing steadily, so that will continue to grow. But their fee income, bulk of it comes from wealth management income, right? So that comes from the AUM that they have. So with a larger AUM base and with investor sentiment now shifting towards higher risk-on sentiments, right, this could actually boost their fee income, and they could be earning higher percentage or margins on this large AUM base that they have. So the fee income will be a very healthy earnings provider for them. And looking at their allowances, because I think someone asked about their allowances. Allowances should remain at what it is currently. So for their NPL ratio is around 1.1 to 1.5% for the banks. And if you're looking at their credit cost, it's around 10 to 20 basis points for the banks. So this should be roughly maintained at these levels. We don't see any big indicators unless there are certain one-offs, which we can only know when the results are out, that would sort of hurt their banks for the allowance and provision side. So overall, I think the main thing that people will be looking at would be the dividends. What is to be expected from the dividends, right? For DBS, it has been said very clearly that they're going to continue their dividend growth. So I think the minimum baseline we're looking at, it would be around a 6 cents increase, because they did say 24 cents per quarter. So 6 cents on top of what it is currently. That's the growth. Hopefully it goes above that. Whereas for the other two banks, it's capped at 50% of dividend payout ratio. So I think they will be maintaining at that level. So that's the expectations that we are going for. We could have some increase if the earnings are continuing to show growth, as we've seen in the first quarter. If that is the case, then we could see a few percentage increase in their dividends. So overall, that's the quick hint on the outlook, at least preview on the second quarter earnings for the Singapore banks. So I've answered half of the next question, which is what are the loan deposit ratios and the bad debts allowance for Singapore banks? So I answered the second half earlier. For the first half, the loans deposit ratio is at 80%. We haven't seen it move much. I think it's been hovering at these levels for quite a while now, which is quite healthy. And despite even the deposits have been sort of continuing to rise and loans have been rather stagnant, but this ratio has actually not really changed much. Around 70 to 82%, I think, for the banks. Okay, let me scroll down. I think early thoughts on the US banks results. So the US banks differ slightly from the, where did the question go? US, hold on, where is it? Yeah, anyway, early thoughts on the US bank results. So for the US banks, we are looking at it that their cost of funds have really hurt them, which is why their NIMs and net interest income has been showing this rather big decline, right? And it's continuing to do so. So the higher for longer interest rate environment is actually hurting the US banks more than the Singapore banks. And why is that so? Because the US banks have a large proportion of their loans that is fixed interest. So they give, like, let's say 3 or 4%, and then they lock it down for a few years, right? Whereas in the Singapore banks, the difference is that they are mostly floating. So they charge they charge a spread on the loans that they give out. Hence, they're not as affected as the US banks. So the higher for longer interest rates are actually hurting the US banks. And secondly, their provisioning also has increased. And this is mostly coming from their credit card provisions or allowances. And their net charge-offs has also increased, as the overall environment is feeling the pinch from the higher rates environment. So that is also what hurt them. And secondly, loans has also been has been quite negative. It has not grown much. However, what is the positive for the US banks would be their investment banking has shown like 50 to 60% growth. And this is mainly actually coming from a very low base in the previous year, right? So overall, I think they are being very cautious and they're being very prudent. I think JP Morgan CEO said it very well, where he mentions that they are looking at everything in a not a very bright outlook way at least for the bank. So they are holding on to quite a bit of their capital as well. So they're not doing as many share buybacks as they could. Let me find that question again. Hold on. Okay. Someone asked about the update on the OCBC Great Eastern transaction. So this is I think it's the most interesting news we have in the Singapore banking sector. Okay, so for that, it closed on 12th July, and I think as expected, it fell below that 75% level, right? So what will happen now? 75% of unowned shares level, right? So what will happen now is that they still own more than 90%. I think as of when it was closed, they had 93.52% of total shares, right? So what will happen now is that trading will definitely be suspended for Great Eastern, but I think from what I read is that the shareholders who have not accepted the offer, so they call this the non-assenting shareholders, will have a right under an object subject to this section of the Companies Act to require the offerer to acquire their offer shares at the offer price, right? So there's still a chance, I think, to for a period of 3 months. So there's still a chance that I think they can still give it here. But I think this one we need to double check. But so what will happen now moving forward is that there's probably they will fall into the second scenario, right? Which is that they have fallen under 75% of the total shareholdings, of unowned shareholdings. So what will happen is that the SGX will probably approach them and ask them to see if they can bump up the free float to higher than 10%, and then hence it can be listed again. Because now they cannot delist the Great Eastern because they still do not have the proper shareholdings or conditions have not been met to delist Great Eastern. So they only can get the trading to be suspended. However, I think for them to even give a new offer, there's a 6 months break. So as of now, SGX will just keep chasing them to restore the free float. And after that, after the 6 months, we have to see again what OCBC will do. If not, if they will give a higher offer and hope again that more people will sign up so that they can get the 75 threshold, or if they will have to get GE to restore the free float by putting in more shares. So this is really quite a new territory that we have entered into. So I think we just have to wait to see what will happen. Any updates I will provide on the Monday webinar if there are any updates. I think there's one more for me. Yeah, it's JP Morgan's buy, hold, or sell. So we still have a buy call on JP Morgan with a target price of $231. Yeah. And why mainly? Because we feel that they have very strong and consistent earnings. So they did again outperform their peers, and also they also have exceeded They have exceeded the expectations of the market, and also they have continued to give their continued share repurchase, although it's not as aggressive, but they did continue their share repurchase program at their current net pace of around $2 billion US dollars per quarter. And their net interest guidance is also the strongest. I'll give more highlight updates next week when we have completed the report on JP Morgan for the second quarter results. Let me see if there's any more for me. Okay, I think that's all for me. I'll hand it over to the rest of my colleagues. Thanks.
Okay, thanks, Glenn. Let me just try to read out some of the most upvoted ones. Is Astria 8 a good investment with the project and with the projected interesting yield, but with long tenure 2039, and if interest rates go up, will it have a negative impact? Yeah, I mean, in general, if interest rates go up, it will definitely have a negative interest rates. I think there are two tranches. One is 4.35, the other one is 6%. In general, it looks fine because it's ultimately a Temasek bond, but of course, there's no guarantee by Temasek. Number one. Number two, this is available. There was a question. This is available for all retail. This is not only for accredited. Number three, there are some safeguards. The safeguard is that there's a loan to value which is 40%. That means for the $40 of loan, the assets that backing it up or the private equity funds is $100. To me, it's not really a big safeguard because you don't know what's inside all these $100 are back. Anyway, so these bonds are backed by the 30 plus private equity funds, and these 30 plus private equity funds invest in almost 1,000 companies. Okay, it also means they're not sure what they're being. I'm just kidding. It's like that maybe they can't make up their mind what they're investing, but it's backed by 1,000 companies. So these are some of the protections. Is diversified. The other thing, the fifth one is this is investment grade. So this is already rated by Fitch of investment grade. But for me, the more important one is that they actually are going to park some cash. So if I'm not sure if it's annual, that one I need to check. There's actually a webinar we're going to host with them, but they're going to reserve some cash to make due the payments, which the first call will be 2029 in 5 years time. It's actually a 10-year bond, but I think the first call is in 5 years. Then the other more pertinent thing is that most of these S funds are already hitting their 6th year, so there is some maturity there. So it's like time to realize these investments. So I mean, if these because this PE invests in companies that if they are 1 or 2 year maturity, then maybe there's some risk, but they are already like 5-year-old kind of their stated type of companies. So there's already maturity. So your risk is number one, the risk is interest rates, of course, and number two, your risk is they can't do a trade sale or they can't realize. Or of course, if there's a downturn and then all these companies go bankrupt, but there's almost like 1,000 of them. So I think generally these are quite reasonably safe, I guess, because since they have an investment grade, there's a investment grade rating, and it's implicitly this is a domestic link of bond, I guess. So I think that's why the last few issuance it was quite popular. Please comment on Wilmar. Wilmar, really no change. We don't think the results is going to be strong for this quarter. Most of the macro things that you look at, like consumer spending in China, hog prices or pork prices, like a better word, sorry, in China, they're all just trending sideways. So we don't think it's going to be a strong quarter for them. The second quarter results, which is, I think, is going to be released in 13 August, I think, or 14 August. And the third thing is palm oil price is sideways. So to play this sector, I would rather buy into a pure plantation company than Wilmar for now, until we see some pickup in activity in China. Because Wilmar is very dependent on the Chinese consumer. So from what we understand is that the Chinese consumer is spending, but they're not upgrading. So they're not buying the quality type of oil, higher quality food, higher quality oil. So that's why you're not getting really strong margins out of it from China, for Wilmar. So it's better to just buy a palm oil company if you want to get exposure to this sector. I mean, this is just our general comment. Paul, your comment on HR Net Group, do you still have conviction for this counter, as it used to be quite frequently mentioned by your team last year, if I'm not wrong? Yeah, I think we mentioned it quite a lot in 2022. But I think near term, okay, so just to tell, this company is still, the business model is still fantastic. I mean, their ROE is like probably 30% or more, and most of the balance sheet is in cash. So they have like 300 million Sing dollar cash. Market cap about 700 plus. So half the market cap, or 40%, is roughly in cash. The only issue right now, in the near term, is just the growth, because the employment market is slowing down significantly. So they did get that big growth in 2022, post-pandemic, or there was a big hiring, and even the pandemic kind of benefited them in a way, because a lot of the healthcare workers, the government needed healthcare urgently, so they're willing to pay. So I think this near term, they are in a lull a bit. I think near term, the growth will be just a soft. But I think they're still paying attractive yield, maybe 5-6%. So that's my only concern now is just the growth, because the whole labor market conditions, because they're also reliant on China too. So the whole Asia, the results will be coming out soon. So the whole Asia Pacific, I think job employment situation isn't robust. Okay, Paul, has there been any increase on fund flowing into our SGX market gradually past week? Okay, I don't really, I mean, personally, I don't really look at fund flow data, because I just look at the market. If the market goes up, means there's fund flowing in. So sometimes that's why SGX always asks us, do you need the data? I say I don't need. I just look at the market and the share price. I can tell you that there's funds flowing in. But apologies to that. I mean, I don't have the exact data. If you want, we can try to compile it. The problem is they also kind of restrict. We always wanted to have this like a 12-week flow, not like every week, but like a 12-week rolling number. But it's kind of restricted to like even insider trading news, data also SGX restrict. You have to pay money to get the data. I'm not sure. Not like it's a very popular exchange in the beginning with, but yeah. So that's why there are some of these good data we've always wanted to compile, but we couldn't. But okay, but I need just to sidetrack comment. Yeah. Comments on Capital Infrastructure Trust and CSE. I don't really have any comments on Capital Infrastructure. Never found it attractive. But for CSE, I do attend their briefings for, I don't know, maybe 10 years. So for CSE Global, the share price was a bit hampered because they did a placement with at 40 cents. But I think the first half results is going to be strong because they are doing a lot of okay, there's basically a major capex cycle in the US, believe it or not, on the utilities. A lot of substations need to upgrade. Uh, Probably Singapore doesn't need to do it that much because we did kind of upgrade. But in the US, they realize that if they're going to install a lot of EV charging or that, their whole infrastructure cannot cope with it. So that's why CSE's order books are at record levels because they are doing a lot of this upgrading of the substations. So I think CSE will look good, I think, the next 1 to 2 years, I think, because this cycle. And related to this question, there's another question that the President Trump was attempted. There was a shooting, and then how does this news will affect US market tonight? Is there any short-term trade opportunity to tap into? Example, DJT, yeah. I think I think that's probably the nearest if you want to punch. DJT basically means it's the Donald Trump spec. I've forgotten the name. It's called digital something. Yeah, apologies, just slipped my mind. Yeah, but you're right. I mean that will be the trading opportunity. For Donald, is Donald Trump's spec. I just slipped my mind. Maybe can get ask Zane to get the name for you. But how will the news affect? I think there are some longer term trends. I think under the Trump administration, then of course people worry about inflation, and they think oil price could come down because he's going to and renewables will be affected. But the key thing, I think, the market attention no longer focus. I think, like we highlighted, is no longer focused on the presidential race because I think probably it's already been won, but it's more focused on who takes control of the Congress. So I think that is probably where the focus is. But I think if there's a trading stock, yeah, I think DJT. But I think DJT's price to sales, their market cap of 5 billion, their revenues, I think 3 million or 4 million. So their price to sales, I don't know, a few hundred times. But again, you're just buying on the narrative. It's like a meme. It's like no, it's those. It's no, it's like 99.99% just a punting stock. I mean, just. But you're right. I mean, yeah. I'm not sure what's the name of the stock again. It's the Trump media stock. I can't remember. Maybe Zane can help me. Okay. Let me just try to answer a few, Paul and team. Oh yeah, this one is regarding the celebrity event on Genting Singapore. So we still think this year will still be a healthy year for hospitality, mainly because Chinese tourism is just starting to pick up. I mean, they grew 90%, so Chinese arrivals are doubled. So it won't go to zero. So we think it will go to 90, 40, 50. It will slowly trend downwards. Probably by year end, then it will start to normalize. So I think this year for Singapore hospitality stocks, I think there is still growth this year. Just that next year, then you might go back to the steady state of maybe 5% type of growth. But this year will still be strong because it's going to be well supported by Chinese tourist arrivals, which technically really only started to come in only middle of last year because there wasn't many flights, and then now we have visa free. So visa free only started in Singapore this year, and then this is visa free across ASEAN, which is important because the Chinese arrivals used to come here but then cannot go anywhere because there's no visa. Going to apply visa, go Malaysia. Now there's visa everywhere. So I think this phenomenon will probably carry on until the year end. Yeah. This is the CDL question. Paul, can you arrange a webinar by Fortress and Southern? Yeah, which one is better choice of investment financially and going forward? Okay, we tried before to try to get Fortress. I think the attendee asked before, but they didn't want to do it. But I think in the very near term, I don't really look at Southern because Southern Alliance, they don't do any briefing. They probably just talk to themselves. But so for Fortress Minerals, near term should still be healthy because you're going to get this big production jump. Then thereafter, that's where the issue lies. Then investors will start to question once like the funding for the copper miner. Then where are they going to get the funding for copper? So for the new copper mine, like we highlighted earlier. But I think near term that there will be growth. But whether investors are going to trade along that growth, and I'm not sure. But it should be a strong FY25. Yeah, True Social. Yeah, sorry. Yeah, thanks for that. Yeah, it's called True Social. Yeah, True Social is the app, but the listed company is called something else. Yeah. Okay, and I hand it over to Zain. Yeah, yeah. True Social is that so-called Twitter equivalent that owns which is owned by this so-called SPAC.
Thanks, Paul. Okay, so DJT is just the Trump Media and Technology Group Corporation. Then True Social is the social media platform. Okay, so I'll start with the TA. Let me just share my screen. Okay, so the first question is on sets. Okay, for sets, I think it could still be some upside here because we're still seeing a bullish trend continuation over here, and then price is entering into this this gap area where price gap down previously. So there's no volume over here. So price could still go up higher, I think, given that it's cleared this level at around 322. So next key level, I think it might face some resistance around 355 to about 366 this area over here. So I think for now, price could still go up further. The next one is on Singtel. Okay, Singtel's also managed to $2.90 was a key resistance level back in 2017 and 2019 over here. Then price recently still showing strength above it. Still holding well above the 5-day moving average, which is blue over here. And then also did a retest of 290 and still holding. And then today we're still seeing new highs at $3. So I think with that, short-term momentum still very strong. Could still see price go up higher towards next key level will be the next key resistance will be around $3 to about 3.05 or that. There will be the next resistance area. Yeah. The next one is on 103 Hong Kong, which is a CK Infrastructure Holdings. Okay, for this, I think last week there was a range consolidation breakout over here. There was this gap up. So the range previously was between about $42 to about $46.50. So that's about $4.50 range. So projected target level probably about 51 might be the level to look at. In terms of previous resistance levels, probably about this next key level will be around the $50.40 level. And then yeah, and so I think short-term wise price will still go up higher with this fresh breakout over here. Okay, next one is on Apple. Okay, Apple, I think some short-term price recovery, but likely to do some range consolidation because so last week it was a break of this downtrend resistance line, and then price retested this resistance over here around 678. With that, I think some short-term consolidation to be likely, but when price remains above 663, so maybe some range bound consolidation for the time being. Okay, then next one is on Semcon Industries. Okay, Singapore industry, I think still finding resistance at this key level, which is around 484 over here. So this was a previous support level, then price broke down below it start of this month and then continue to act as resistance recently when price keep on testing it. So for reversal, price need to claim back above this level. For now, probably some range bound trading, I would think between 470 to about 485 with this area. Okay, next one is on iFast. Okay, iFast, I think currently slightly still range bound. We have recently tested the resistance at 766 and then there was a pullback. Price is just continue range bound here, holding above this recent breakout level of 743. So probably some sideways consolidation is quite likely over here for time being. The next one is on Bumi Tama. I think for this is I think it's looking more towards the bullish side in my opinion because there's been multiple retests of the resistance at 71.5 cents. Price has been forming higher lows along the way, so we can look at this like an ascending triangle. So if there's a closing break above 71.50, 72 cents, I think price could go up in the short term to test this near-term resistance at 73.5 cents. So this is like a consolidation for now. So we see whether there's a breakout coming on. Okay, next one is on Food Empire. Okay, for Food Empire, I think currently likely is still quite range bound. So price test found some support at the support level 96.5 cents. Then seeing some rebound currently at the first resistance level, which is $1.01 to $1.02 level. So over here, I think price could do some sideways over here, where support would currently be around 99 cents. Yeah. So then afterwards, if you can break up again, then it could see some further recovery towards 105, 106. For now, I think probably still some sideways, given the downtrend is trading at. Next one is Samudra Shipping. Okay, Samudra Shipping, I think not so good for now. Usually price was holding above this 102, its previous horizontal resistance level, and then there was a large sell down with volume on last Tuesday, breaking below this swing low support 96 cents as well. So with that, probably we would likely to see a lower high being formed. Maybe resistance could be around 97 cents to about 99 cents area for now. Yeah, so for now, maybe some rebound, then price could do some sideways consolidation with some support currently around 93 cents level. Okay, Aztec. For Aztec Global, I think price is still holding up well since breaking above this $1 area. It has been just doing sideways consolidation. So still finding support at this previous resistance level, quite low volume as well. So I think if can break above the recent highs, we could see price go up a bit higher towards the next resistance level, which is around $1.05 to about $1.07 area. And this one is on Franken. So for Franken, I think still holding up well. Price is from this range of 156 to about 164. Price is still holding at this resistance level 164. So that could still see price extend its this upwards move towards 171 about that. Yeah. Okay, next one are some US counters. Dell. There, I think probably some range consolidation for now. Still holding above this uptrend support line in blue. Short-term wise, it's just some consolidation between 137 to 149. So I expect that to still continue for a time being. Okay, next one, Tesla. Okay, Tesla last Thursday, there was a pullback since testing the swing high of 265, some resistance at 265 around there for about 3 days, and some sell down, and on Friday, some recovery back at a 10-day moving average in break over here. Currently, I think it's in Asian hours is about up 5%. Currently, so it's about 261, 262 area. So we probably will see a retest of these recent highs. There might be some short-term resistance today at these levels. But I think if price can clear again, I think we're likely to extend its uptrend towards the next key level at 279. The next one is on AMD. So AMD has also been strong recently. Last week, it broke above the $173 resistance level, and then currently consolidating after testing the 187 resistance level. With that, I think maybe some sideways consolidation first, but if price can break above 187, I still think price could go up further towards maybe close to 200 first, which was a previous breakdown level over here. And then look at the projected target level of this cup and handle could reach about 205. Yeah, so 200 to 205 should be then. I think it's still possible for price to reach there if there's a breakout of this 187 this week. Okay, then next one is on Alibaba. So Alibaba, some recovery in terms of the price recently with this resistance level breakout at 76. So currently testing the area at this 80 to 81 level. I think over here there might be some resistance because of price over here there was previously this was a key support resistance area, and then there was also a high volume over here previously. So we might see some short-term pullback, but I expect some support to come in at this level of 78. So maybe some range-bound consolidation first. The next one is Dynamic. Okay, for Dynamic, it's still very strong. Since the breakout over here, price consolidated, then holding along the 5-day moving average. Then today we still see price go up again. So I think with that, it's likely that price could still go up further. Next level to look at previous resistance level of around 53 cents. That will be one level. And then the next level will probably be around 56 cents level for Dynamic. Okay, next one is Hong Kong Exchange and Clearing. So HKEX recently there was a break out of this downtrend resistance line recently. Only some short-term resistance over here, which is this 254 level. So price might do some pullback. Support wise will be around 245, 246. 245, 246 over here. Then if this holds, then price could do the further recovery upwards towards 260. Okay. Then next one is on JD. For JD, also some bounce recently to retest this previous breakdown level at 29. With that, some resistance over here, then I think probably some sideways trading with support at 27 to about 27 to about 27 60 about there. Okay, then next one is Meituan. So for Meituan, I think for now is some range bound consolidation, but price has been forming higher lows along the way over here with resistance at 121. So I think if there's a break again of over here, might see price go up to test 129 resistance over here. So range consolidation for now, but I think there's a chance for some upside if we test the resistance again. Okay, then next one is on BYD. For BYD, I think it's still trading along this uptrend channel over here. Let me just highlight the blue. So there might be some resistance that comes in at about 246 at these current levels. So maybe some slight pullback, but probably I think it's probably will be a shallow one with this recent resistance breakout at 240 likely to fall as support. So maybe some range bound consolidation over here for the time being. Okay, next one on city developments. Okay, city developments, I think for now, there was a break of the resistance at 535, 536 over here, and then retested this previous support breakdown level of 550. So maybe some sideways consolidation as well at the current levels between these 535 to 550 levels. Okay, then for Parkway Life, I think also quite range bound. Again, testing the key resistance of 375 over here, which was August last year as well as February of this year held as resistance. So I think I should pull back from this level. Short-term wise might see some support at around 370 about it. So maybe some sideways for the time being. Okay, then next up, Mapletree Logistics. So for this, I think for now, some recovery maybe towards to test this resistance again at 130, 139. So maybe and then afterwards, maybe some sideways consolidation after. So probably still kept this range bound between 128 to 138. The next one is Fraser Logistics and Commercial Trust. So for this, there was a breakout of this downtrend resistance line following this double bottom over here at 23 cents. I think for now, it might head towards this key resistance at $1 at 1 to $1.02 level. Afterwards, might do some sideways consolidation afterwards as well. Okay, then moving on to the three local banks. First, I'll touch on DBS. So DBS currently, I think, is still some sideways consolidation for now. I think currently resistance around $38.10 about there. Price can't clear above it for about 2 days currently, but still holding above the 5 and 10-day moving averages. So for now, yeah, maybe some sideways consolidation for the time being. First support level it is 37.70. Then next one is at around 37.20 about there. Okay, then next one is on OCBC. OCBC, I think still quite strong. Just hugging along this 5-day moving average. So, yes, short-term support wise is $15.15 about here. And if you can break above $15.35, then we likely still see new highs again. As for UOB, and UOB also, I think some range bound similar to DBS as well. Some resistance for now at above $33.10. Support is around 3260, about 3270 about there. With this horizontal resistance level as well as the 10-day moving average. So maybe some sideways consolidation first. Then if there's a break over the resistance, likely to see the uptrend continue. The next one is on MPW, Medical Properties Trust. Okay, so for this, I think some rebound from the support at around $4, and currently it could be some resistance at 465 to about 480 area over here. So price could turn down a little bit if we retest this level. Then support level will be around 433 about it. So maybe some range bound consolidation for the time being. And for next one is a Realty Income Corporation. And for this, price managed to break above the resistance over here at 55, so could head towards 56.50 about there. Then you might see some sideways over there. If it break again, then next level to look at will be around $58.10. The next one is Innovative Industrial Properties. At this level, I think it's clearing about the resistance of this $113.75. With that, I think it could still, if it holds this breakout level, it could still go higher towards the next key level, which is around 130 to 133, which was a previous support level breakdown. And next one is on EPR properties. EPR currently doing a retest of this swing high resistance at 43 about there. So might see some slight pullback. Then might do some range consolidation first. So I'll talk about ODC. Okay, for Capital DC, currently we tested the resistance at $2.03, level. There's currently some drop over here, but I think price will find support with at around 191 to 193 over here. So probably some sideways consolidation for the time being. Okay, then for CapitaLand Ascendas REIT, at least it looks like a double bottom being formed at 253 with that. So interesting price is there was a gap up above the resistance of 269 over here. So with that price could if price is holding above this resistance, I think could still see some upside towards the end target could be around 280 to around 283 about there. But for now, the next resistance level will be around 277, then followed by this 283. So let's see whether the price can hold on this 269 resistance. Okay, then next one is on Mapletree Industrial Trust. Okay, for this, there was also breakout of this downtrend resistance line. Then currently is next resistance level is 233 about there. So we might see some price consolidation coming soon. But support will be around 226 around there. Okay, then for Wilma, I think for now, probably some sideways some range bound consolidation. It's just trading between 307 to 319. So I think for now, they will likely still continue. Then for Citrum also is also in the range over here. So it's between 137 to 148. So currently, as it stands for today, still some resistance at this level, which was a previous support level breakdown over here. So for some price recovery, you need to see price clear above this level. Then next resistance level will be around 155. Yeah. It's as well. I think for now nothing much. It's still quite range bound over here. Yeah, so resistance is around 69 cents level. Support is about 65 to 66 cents. So for now, still some range consolidation, I guess. Okay, next one is First REIT, also quite range bound. Resistance is around 26 cents. Then support is about 23.5 to 24 cents. So yeah, some range bound over here as well for the time being. Okay, for Manulife, US REIT, for this, it managed to clear. There was a managed to clear above this previous strong support 0.068 level, then tested the next level 0.075. With that, maybe some sideways consolidation first. I think short-term support-wise, we'll be looking at 0.072 about there. So maybe some sideways first. Then if you can break out again, then it could hit higher towards the next levels, next resistance close to 0.80, 0.080, 0.82. The next one is on JP Morgan. So for this, I think price is just holding in the range bound formation at this previous all-time high at 204. So just some range bound 204 to 209 consolidation currently. Then for Citibank, some resistance along this trend line, currently at 66.60. So some slight pullback over here, but I think it's probably still range bound. Support is around 63.20 about here. So probably some range bound consolidation around here. Then for Wells Fargo, there was a gap down after the results. So for now, it might go on to test this support area 55.30 to 55.40. If it holds, there might be some rebound coming. Then short-term resistance wise will be 57.70 here. The next one is Bank of America. Bank of America, I think it's still some consolidation after breaking above this ascending triangle resistance of $40.30, $40.40. Some resistance at this close to $42, which was a previous swing high level. So I think with that, if you can break above, then next key level to look at will be around 43.50, then followed by $45. Okay, the next one is on ComfortDelGroup. Okay, for comfort, I think for now it's some range bound consolidation with resistance at this 140 level, which was this previous range consolidation over here. So then support will probably come at around 136, 137. So maybe some range consolidation for the time being. Yeah. Then for Jaffa, okay, for Jaffa also some range consolidation. So near rebound, there was a pullback towards the support near 30 cents. Then there was some rebound. So for now, I think resistance will come around 33 cents and above. So 33 cents is one level, 34.5 cents is the next level. So probably still kept in this range over here. The next one is on Best Buy. For Best Buy, I think maybe some range bound consolidation for time being. Price there was a retracement towards to retest this resistance breakout 82.15. Some bounce was the current resistance level $88. So maybe some range bound consolidation with support currently at around 85. The next one is on Humana. Okay, for Humana, I think some range bound is for now, I guess. So there was this high volume spike to test $338, which was a prior this swing low. Then price did a pullback to hold above this 365 breakout level. So probably some resistance when it comes to this if it does a retest of this high volume day price over here. So maybe some range consolidation. Okay, then next one is on Salesforce. Okay, for Salesforce, I think is slowly climbing up, did a retest of this breakout at 246. So for now, maybe some slight consolidation is between this 250 level to about 260 over here. I'll just do one more and I'll hand over back to my colleagues. Okay, for MasterCard, MasterCard, I think some rebound from a retest of this prior resistance at 430, but quite a lot of resistance, might be quite a lot of resistance over here with this, I think it's a previous support at 440, 444. So over here might be a retest, then might face resistance down again. So I think for now, maybe some might be just consolidation between 430 to 440. Yeah, given that it's still trading this downtrend over here. I think I'll just have a time to my rest of my colleagues to answer some of the other questions. Thanks.
Yeah, I'll just take one of the CDL question. What's the expectation of CDL incoming quarter result? Yeah, so for this quarter, or rather the first half, we're expecting the results to be still quite lackluster, especially the property development side. But the Singapore operations will likely lift it a bit, and hospitality sector might do quite well as well as the PRS, the private rented sector might do quite well as well. But the UK operations also might be a bit weak. Yeah, so that's my expectations. Yep, I think I'll hand it over to my colleagues. Thanks.
Thanks, Darren. So let me just try to wrap up. Some of the questions I answered it through by typing the answer. So sorry if you didn't get it. But like some questions like nanofilm, why it jumped up? Nanofilm is tagged like a Apple supplier. So I think there was a Bloomberg article that showed that there's been an upgrade in forecast in the supply chain for Apple units. So I think that's why it ran up. There's this question on Astria, denominated US denominated bonds. So that's the A1. Let me get this right. So sorry, the A1 bond, the A2 bond, the US dollar A2 bond is denominated. Their coupon is 6.2. So let me just look at this. 6.35 versus the Singapore one, which is 4.35. The reason why they are a bit different is mainly because the A1, maybe that's why it's called A1. The A1 Singapore dollar one is 4.35 because they mature. There's a call date 1 year earlier at 2029 versus the other one 2030. And also the reserve mechanism where the cash flows that are set aside to pay the bonds is given priority. They rank pari passu if there's a default. But I mean, yeah. But in terms of cash flow arrangements, the A1 is given priority, then only the A2. I think that's one of the key differences. That's why there's this 2 percentage points of difference in the interest rate. Yeah, it's more the ranking of the cash flows. Yeah, but again, do remember we have a call with them. If you go to our Poland's website, if you do register, there's an Astria management call tomorrow. I think 12, if I'm not mistaken, but it's tomorrow. There's a call, and so I mean, these are all very good questions. I mean, you do have, no, feel free to ask them too, because I'm just worried I don't get the right answer because I'm not in charge of this thing. Okay, there's one more impact on today's China growth rates released in China banks and Ping An. We don't cover the Chinese banks and Ping An, so yeah, we don't look at the Hong Kong China stock. So sorry for that. What is this Singtel dispute all about? Any impact? I don't think that was the reason why the share price moved up, but this has been the case all along. It was never an overhang mentioned. I don't think anyone ever asked the management a question about this, regarding the dispute with AIS, because AIS is still anyway just one of the smaller associates compared to Indonesia and also India. Okay, I think we hit the 1 o'clock. So thanks everyone. I tried to post as many questions, some of those questions by text earlier, so no, feel free to read them. So and apologies if we don't take on. There's still quite a number because we try to end it at 1 p.m. There's one more question on Seatrium outlook. So for outlook for Seatrium, I think it should still be positive because I think Seadrill is still guiding 11 FPSOs to be awarded, 11 each year. So next year and the following year still have they're still before the cycle ends. So I think there could be 2 more years of orders based on Seadrill's forecast, which is Seadrill is one of their customers. Okay, with that, thanks everyone. Sorry to delay this across one. Thanks for all your time and all your questions, and hope to see you soon. Hope to see you again next week at 11. And take care, and hope everyone have a really good week ahead. Thank you, everybody.